The lobby holds the stillness of an institution that believes in itself. The carpet is thick. The fixtures are brass. Depositors trusted the seal above the door. The seal was backed by a promise. The promise was backed by nothing yet visible. Capital moved into real estate with institutional confidence. The structures rose. The projections rose faster. The deregulation arrived as relief. Thrifts could now lend into territory they had never charted. Relief often precedes the reckoning. Examiners were reassigned. Positions were left empty. The gap between obligation and oversight widened without announcement. Interest rates moved in directions the thrifts had not prepared for. The mismatch was structural. It had been there from the beginning. The insurance fund held reserves sized for a smaller era. It had not been recalibrated. No one had required it to be. Thrift executives moved capital toward commercial projects of considerable scale. Due diligence thinned. The deals moved faster than the oversight. The appraisals were optimistic. They were accepted. Optimism inside an institution often functions as policy. The first institution closed. The process was orderly. The fund absorbed the loss as though it had been designed for exactly this. The closure was processed. The regulators noted it. The remaining institutions continued operating without revision. Real estate values across the Southwest began a quiet retreat. The retreat was not uniform. It was not reported as a trend. Thrifts holding insolvent portfolios remained open. They took in new deposits. The guarantee applied equally to both. High interest rates attracted depositors to failing institutions. The rate was real. The institution behind it was not. The insurance fund's actuarial basis had not been reviewed. The premiums collected remained flat. The exposure had multiplied. Regulators received notices of concern from field examiners. The notices entered a process. The process had no urgency attached to it. Congressional pressure slowed the closure process for institutions in certain districts. The mechanism was procedural. The effect was structural. Every month, an institution remained open while insolvent added to the eventual cost. The cost accumulated invisibly. No counter tracked it publicly. The accounting rules permitted thrifts to carry assets at original cost. The original cost no longer reflected reality. The rules remained. By the mid-1980s, more than 500 institutions were technically insolvent. They opened the following morning. They accepted deposits. Brokered deposits arrived in large denominations from distant cities. Each tranche fell inside the guarantee threshold. The risk pooled silently. The Federal Home Loan Bank Board issued cautions. Cautions required a response from management. Management responded with assurances. The assurances were filed. They did not alter the underlying condition. The underlying condition continued to compound. The pattern is not new. Systems with deferred accountability tend to continue past the point their own records justify. Those who observe it closely know that documenting is the first form of reckoning. Texas thrifts held collateral in a market that had already turned. The collateral was still carried at peak valuation. The gap widened daily. The regulators who identified problems were not always empowered to act on them. Authority and knowledge resided in different offices. Neither office moved. The insurance fund's reserves fell below the threshold required to cover pending failures. The arithmetic was now beyond dispute. The system crossed into a new condition. The fund was depleted. The guarantee remained in effect. The public was not informed of the difference. Institutions continued advertising their rates. Depositors continued arriving. The ritual of normal business continued in buildings that were no longer solvent. Congress authorized a modest borrowing mechanism to extend closures over time. The mechanism deferred the reckoning. The reckoning did not diminish. More than 1,000 institutions would eventually require resolution. The number grew each quarter. It grew inside a system that preferred not to count. The closure backlog accumulated while staff levels at the regulatory agency declined. The agency managed the backlog with the tools it had. The tools were insufficient. Seized assets flooded an already weakened real estate market. The government became the largest holder of distressed commercial property in the country. It had not intended this. The Resolution Trust Corporation was created to absorb the wreckage. It was a new institution given an old problem. The problem was larger than any institution had been designed to hold. The agency disposed of assets at prices the market would accept. The market accepted very little. The process extended across years. The eventual cost to the public exceeded $130 billion. It arrived through appropriations. No single moment announced it. The appropriation passed through committee. It passed through the chamber. It moved into the infrastructure of public obligation without ceremony. Depositors who had trusted the guarantee received their funds. The guarantee had held. It held because the taxpayer had replaced the fund. Reforms followed. They addressed the structures that had allowed the accumulation. The structures had been in place for over a decade before anyone moved to close them. The new capital requirements were stricter. The new examination schedules were more frequent. Neither change addressed the years in which neither had existed. The thrift industry contracted sharply through the early 90s. What remained was smaller. It was also more heavily watched. The communities that had relied on these institutions found different arrangements. The capital that had once flowed locally now followed different channels. The local economy absorbed this without visible ceremony. The historical record does not locate a single moment of failure. It locates a sustained period of continuation. That is where the cost was built. The guarantee had been the foundation of depositor confidence. The guarantee had outlasted the foundation beneath it. Both remained in place until they could not. The lobby holds the stillness of an institution that has already been resolved. The carpet remains. The brass remains. Nothing is owed here anymore.